So with interest rates as high as they've been in 15 years, some are asking, with these high rates now available even for money markets, are stocks necessary or even advisable for investment today? To try and answer that question, let's start with a quick review of the global and economic news at the end of 2022. Remember that Ukraine and Russia were still at war. Most recent CPI was just over 7%. Recession in 2023 was thought most probable by most economists surveyed. Earnings for companies were forecasted as going lower in 2023. All of these were perceived as negative pressures on the stock market going into this year. At the same time, at the end of 2022, money market yields were just north of 4% and had climbed throughout the year. The 2022 return on money markets was just about 1.5%. That just reflects the dramatic rise in rates that occurred during the year, especially by the end of the year. But even with all that negative pressure on stock markets and the higher interest rate environment, stocks have significantly outperformed short-term treasury bills and money markets so far year to date. Historically, most of us know that stocks beat cash over the long run, but that doesn't mean that there will be many days that cash will beat stocks. That's because stocks and stock markets regularly have negative days, while cash does not. On any negative day in the stock market, no matter how big or small the decline, cash will likely win on that day. On a day-to-day basis since May of 1997, cash has won 46% of the time. But as the time period lengthens, cash wins less often. Over 12-month periods, stocks win 2/3 of the time, and over 60-month or 5-year periods, stocks win about 70% of the time. Now, because stocks are volatile day to day, missing the best days can be very costly. Over the 20 years ended in December of 2022, $10,000 constantly invested in U.S. stocks could have grown to over $64,000, not accounting for fees and taxes. Missing just the best 30 days reduced that return by over $50,000. And missing the best 40 days would have left an investor with less than the $10,000 they started with. Interestingly, many of the best single days occurred during bear markets. Missing the best weeks or months is a similar story. Stock investors must be present to win, and the best periods, like the worst periods, often come unannounced. Again, history shows that the best periods follow some of the worst periods. The best months for the U.S. stock market since 1990 followed what turned out to be the market bottom of the great financial crisis, March 9th of 2009. Who of us felt like investing on that day? The market had gone down over 50% since October 10th of 2007 and was down almost 25% just since the first of the year in that 2009. Another opportunity cost to consider with cash versus stocks is how each does versus inflation. We've talked a lot about inflation the last couple of years. For long-term investors wanting to grow wealth over time, stocks have provided the advantage needed, especially compared to cash. In 2023, through the end of June, global stocks beat U.S. inflation by 11.5%. Cash, meanwhile, even with the higher yields, did not quite keep up with U.S. inflation numbers over the same period. Over the last 20 years, global stocks beat inflation by an average of 6.2% per year, while cash lost to inflation by an average of 1.2% per year. Looking at stocks and cash relative to inflation by decade, the 2000s and the 1970s were the only decades with negative real stock returns. Cash was negative relative to inflation in the 1970s, but did manage a slightly positive real return in the 1990s. For the entire period, U.S. stocks were up 10.65%, one-month T-bills were up 4.41%, and inflation ran about 3.99%. So stocks beat inflation by 6.6%, and cash over inflation just slightly at 0.42%. How does that translate into dollars? Well, $1 would have grown to $10.06 in one-month Treasury bills over 53 years. $1 grew to $224 in the S&P 500. Now, inflation took back $8.09 from both. So real wealth increased by $2 per every dollar invested in cash over the last 53 years, while real wealth increased by $216.24 to be exact per $1 invested in U.S. stocks. Now, the opportunity cost of stability there was pretty high, but for that cost, an investor avoided significant volatility, including those down periods where the stock market fell over 50%. So what are the takeaways from this comparison of cash returns and stock returns? Well, first is money markets and short-term bonds are great for near-term known expenses. For things that you know you're going to need to spend money on tomorrow, these things hold their value from day to day. They're kind of a good insurance buffer from stock market volatility. However, they're not so good for long-term wealth building or inflation-beating returns. If we look at stocks, on the other hand, they are really good for long-term, or have been really good for long-term wealth building and inflation-beating return. But they're not very good for short-term anticipated expenses because of that day-to-day volatility. Probably the most important lessons are to make your cash, stock, and bond investment decisions based on your entire personal financial plan, including spending plans, growth goals, and your tolerance for market volatility. This will likely indicate the advisability of a broadly diversified portfolio holding all different kinds of investments. Another thing is we really need to continue to embrace or at least accept uncertainty in markets. Prediction is very hard, and the cost of being wrong can be very high. Maybe lastly, right now, we can be glad for current rates, at least if you're using it for cash and money market investments. Cash is yielding something close to or above inflation. This has not been the case for a few years. So for savers, those higher rates are maybe welcome. Finally, remember the axiom that is true for stocks and for some raffles as an investor. You must be present to win, and you don't really know when the wins are going to come. Thanks for listening today. We hope this has been helpful. If you have some questions you'd like us to address, please contact us at Foster Group or Financial Perspectives, and we'll be happy to address those things in future versions. Thanks again. Stay well.